Well, good afternoon, ladies and gentlemen. It's great to see you all here. Welcome to today's presentation, a general introduction and brief discussion on using weekly options. What are weekly options, of course, and what are some of the strategies that we ourselves here at PowerOptions use for the weekly options. We're going to talk about some just general information in the presentation today, and then we're also going to talk about analyzing positions, of course, evaluating positions, some of what we feel are the do's and don'ts regarding weekly options as well. All that being said, let's go ahead and jump right in. First, I just want to introduce to you what is PowerOptions. Well, PowerOptions, of course, is a patented suite of search and analysis tools designed for self-directed options investors. Our tools will allow you to search across the universe of options in just a few moments to find only those positions that match your personal risk-reward tolerance, and we support tools in over 23 of the most commonly used option strategies, including, of course, using standard options expirations, weekly expirations, or what are known as the continuous weekly expirations as well. In addition to that, we offer a powerful set of portfolio tools to help you paper trade, track, and manage your various options position. We also offer countless educational articles, help pages, archived webinars, and help videos to help you get more familiar with the various option strategies and the tools on the site. And we've been in business for over 17 years, actually. Ernest Renner created the PowerOptions tools back in 1997. But everyone here on staff uses these tools to trade their own personal accounts, myself included, so we have many more years of combined trading experience. Now, for those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at PowerOptions. I've had the great pleasure of working with Ernest Renner for the past 11 years. I do handle a lot of the coaching sessions. Those of you that are currently on a free trial or subscribers to PowerOptions know that you can register for one of those free sessions at any time. It's just essentially a 35 to 45 minute phone call. We'll walk you through the tools on the site and answer any questions that you have as well. I have co-authored 2 books on investing with Ernie. I've hosted several live seminars, webinars on various option strategies, and I am versed in all strategies that we support on PowerOptions. Now, just to begin, let's go through a brief introduction here, and some of this might be basic to some of you, and some of it, this might be informational to those of you just getting started in options or with the weekly options. But what are weekly options? Well, they are options that, of course, have a weekly expiration, 7 days out, 14 days out, 21 days out, rather than the standard 30 to 35 days out that we used to all be able to trade back, 8, 9 years ago or so. The key to remember when evaluating any kind of weekly option in any strategy is that you have the same exact requirements and obligations and calculations for break-even, return, and probability as the standard options. Nothing really changes as far as the trade structure in a given strategy, the rights, the obligations, and the risk-reward ratios, just with different numbers based on premium size and strike difference. We have a shorter time frame, which really is an advantage to those of us that are trading more sell positions, i.e. income generation, credit spreads, condors, things of that nature, calendar spreads even, maybe naked puts, cash-secured naked puts, or covered calls as well, or the reverse, covered puts or naked calls also. Whereas with any option, the shorter time frame you go, you're going to increase your annualized returns. Also, the weekly options give us a much better flexibility of management. Now, right now, about 1/10 of all of the optionable securities that are available on the market and the different exchanges offer weekly options. They have an expiration date, of course, on Friday. But now in the old days, when you read the old literature, when you're just getting into options, you would read things that, well, the options expire on the 3rd Friday of the month. Well, technically, they expire on the 3rd Saturday. They're cleared out. Well, the weekly options do expire at about 5 p.m., 6 p.m. on Friday evening. But, of course, the last time you and I can typically trade them is around 4 p.m. Eastern Time or 3:59 seconds on Friday of the week. With the exception of the VIX, and the VXX, the VIX kind of settles on Wednesday, I believe, there as well. Now, a very brief history here, just for those of you who are curious. Right around October 28, 2005 is when we saw the first weekly options available on the S&P index, on the CBOE, and they were cash settled just as the regular ones. Later on in 2006, some of the other indexes offered the weekly options. You had OEX, XEO, XSP, and DJX as well. About 4 years later, we started seeing some of the weeklies on ETFs around 2010. And then on June 25th, the first 4 stocks that offered weekly options were Apple, Bank of America, British Petroleum, and Citigroup. And about 3 or 4 weeks later, 4 more stocks came out. I think Ford was one of them, as well as Visa, I think, as well. And then they kept expanding. And within the last 2 years, you had several securities that offered the standard weekly options that were known at the time, and then these continuous weekly options series started to appear as well. There are currently 400 stocks, ETFs, and indexes. Actually, it's about 405. We're going to verify that in just a few moments, that offer weekly options. About a year ago, when the continuous weekly series started to appear, it was only about 10% or so, or 20% of the 400 securities offered what we now know of as these continuous weekly series. But now, any option that has, quote-unquote, a weekly option offers this continuous weekly series. And what we mean by continuous weekly series, you'll have up to 5 to 6 expiration cycles in a row, each week going out in time. So up to 5 weeks in a row you can choose from to trade or to adjust your weekly series to. That was different from the original weekly offering. Many of you remember that when the weeklies first came out, you had options that expired 7 days away next Friday. And then you were really looking forward to Thursday morning, because Thursday morning before expiration is when the new series was released for the next week out. So that's when you could evaluate your management techniques, but you typically had to wait to Thursday morning. Well, now that they've expanded it all to this continuous weekly series, we always have the availability at any time to go to the next weekly series or maybe 14 days out in time. Now, what they also adjusted within the past year or so, in the past 6 months or so, is that most of the securities that offer weekly options now offer more elaborate strike differences. Most of them offer dollar strike differences for the weekly series, and some even offer 50-cent strike differences. This makes it a little bit more combinations there of trying to select which strategy works best, which strike difference works best if you're doing a spread, for example, or if you're just doing a standard single option strategy, which strike price, even though it's only 50 cents apart, gives you the best bang for the buck and the best analysis for your expectations of the position. Now, let's talk about the strategies that we advocate for weekly series. Everyone, of course, has their own tastes, and we'll find out about those in a minute. But remember the standard rules of any options. When buying an option or doing long strategy, if I'm just buying a call speculating on a bullish stance on the market, buying a put with bearish stance, or I'm doing maybe a long straddle, buying a combination of call and a put or so forth, we typically look to buy further out in time. Okay, we look for further expiration periods. Why? Well, number one, it gives the underlying more time to move in our direction to get better profits if we have a long call with an infinite upside or a long put with a relatively infinite upside by definition. The other rule of thumb when you look at options is that the option that's 6 weeks out in time or 6 months out in time is not going to be 6 times the cost of the near-term option. So it's kind of like insurance for your car, for your house in those lines. When you pay your 6-month premium and you pay 6 months up front, they're going to give you a little discount. If you pay a year out in front, they're going to give you a little bit more discount off of paying the monthly fee 12 months in a row. So the cost per day, the annualized cost is much lower when you purchase further out in time, although the upfront cost is higher. Okay? So that's when we look at it. And what this means, of course, is the opposite, that when we're selling premium, selling options in the shorter term gives us a better annualized return as well. So using weekly options for buy strategies, we don't really recommend that or advocate that. Things of doing buying calls with a 7-day or 10-day expiration period, buying puts, straddles, or married puts, meaning I'm buying a stock and I'm going to buy a put option that's 7 days out in time to ensure my position. It's better to actually buy these strategies, use these strategies with options that expire further out in time because, again, you have more time for the stock to move in your desired direction and you're going to pay a lower annualized cost even though you're paying more upfront to begin with. Okay? Oh, okay. This is a question from Johnny. Asked a question, and I'm going to get to this in a little bit, Johnny. When we jump into power options, this kind of relates back to what we were talking about. But I wanted to look at an option chain on power options to sort of emphasize this. Johnny mentions, I noticed the current weekly option had 50-cent strikes, but the following week had dollar strikes. how do we find the ones that have the 50 strikes further out? There's a way we can do that, Johnny. I'm going to show that when you're looking at spread positions, when we're evaluating spread positions. There is a way to do that on power options. But, in general, that's something else I wanted to touch upon, which does throw a little bit more confusion into, I don't want to say the exchanges getting ahead of themselves, but sort of expanding the weekly series as quickly as they did for the available securities. There's a kind of few nuances now that drive some of our investors crazy when they're waiting to look to roll positions and adjust positions. As you mentioned, in some securities, the strike differences aren't always the same between a 7 or 14-day period. Makes things more difficult for adjustments depending on your outlook for the security or your allocation of cash that you're putting into a various position. Okay, so let's jump back into where we were. The income strategies are more commonly used using the weekly options. And what do we mean by those? We want to talk about the ones that generate a credit up front, and we're due a shorter time frame to do the opposite. We're going to increase potentially our annualized return, and at the same time, we're giving the stock less time to move against us. These aren't the only strategies you can use for weekly options, but the ones we feel are most commonly used and that we advocate are, of course, the vertical spreads. When you look at the bull put and bear call credit spreads, and even the bull call and bear put debit spreads, the parities of the credit spreads. Of course, the combination of the credit spreads, you're looking at things such as iron condors and iron butterflies. Covered calls and naked puts. Now, this is also useful because many new investors that are signing up to trade options, if they're using more of a old guard brokerage house, maybe something along the lines of Fidelity or the old TD Ameritrade, not counting their purchase of Thinkorswim, for example. But when you first apply to trade options, you may only be allowed to trade covered calls and to buy calls and buy puts. Okay? So even though you're interested in weekly options and you're interested in maybe some of these leveraged spread positions, you haven't qualified yet to trade those, so you may just be looking at covered calls and naked puts. There is the opportunity for unique setups with what are called collar spreads, of course, where I might buy a stock, sell a call, and then buy an out-of-the-money put, where the call premium is higher than the put, or especially with the diagonal or horizontal calendar spreads, where I might buy a call 3 to 4 months out in time, or maybe now 1 or 2 months out in time, and attempt to sell weekly positions against it, or likewise with the put also. So the strategies that generate income are the most commonly used by the investors we talk to and by the presentations we see. And again, the reason why is that it goes back to that standard definition and that standard view of options. We want to be able to show we're maximizing our annualized returns, and to do that we want to be selling premium in the shorter time frame. Can you be successful buying calls and buying puts on weekly options? Buy a call for a low price, maybe 7 days out, you see the movement that you want, and you close the call out for a gain, or likewise with the put. Is that possible? Yes, it is, but it requires a really sort of good record of picking stocks that go in your desired direction. Really, all strategies do, of course. We want to maximize our returns, but you need a little bit more movement because you're fighting rapid time decay. And sure, you might have only paid 20 or 30 or 40 cents for that long call that expires in 5 days, but if the stock doesn't move in the first 2 days, your call might be down to 10 cents. You've given up about 75% of what you paid into the position when you look at it in that fashion due to the rapid time decay as well. All right, now we talked about this a little bit, but when we're talking about evaluating a weekly position in any strategy, it gets complicated now because we have the advent of the multiple expiration dates. We have a weekly series that may go as many as 6 weeks out in time, so we could pick the 1 week out, 2 week out, the 3 week out. Between there, there's probably a standard expiration, which could still be considered a weekly option. Then you have the 4 week out and the 5 week out. Which one best suits your goals and your expectations? And of course, now we talk about the close strikes, as Johnny mentioned. Some securities will have 50-cent strike differences. Is there a big difference between buying the stock at, let's say, $50 and selling the 50 call, selling the $50.50 call for a slightly lower premium, slightly out of the money, or selling the 51 call? Yes, there's a difference, but based on our expectations of what we're looking for appreciation, plus premium we need to cover the commission cost, that becomes an ever-going battle with the weekly options. So when we select a weekly position in any strategy, we must first factor in the time frame and probability. Is it worth it to get 10 cents, even if you're doing 5 contracts or 10 contracts or 20 contracts? Is it worth it to collect 10 cents of premium for a 5-day trade when you can maybe collect 20 to 25 for a 14 or 21-day trade? Which covers your commissions better? You say, oh, well, maybe the 10-cent credit is okay because I want to get 10 cents this week, 10 cents hopefully next week, 10 cents the next week, so I'll have 30 cents instead of 25 3 weeks out. Well, that's great. But if your allocation, what you're dictating and what you're allowing to go into the various positions means you're only trading 5 contracts or so of a given position, when you factor in your commission perhaps of $12 to $15, are you really making more doing multiple strategies? We'll take a look at some of that math in a little bit too. Make sure the risk reward is not unreasonable. And we're going to evaluate this as well. And what I mean by this is you're looking at maybe doing a bear call or a bull put spread, let's say, on the SPY. And you've got some dollar strike differences available. You say, well, if I sold the 230 call in a bear call spread and bought the 231, I'm only going to get 15 cents. But if I sold the 230 call and I bought the 235, I'm going to get 20 cents because I'm paying less for that further out of the money call. Well, why don't I go ahead now and sell the 230 and buy the 240 and I might make 30 cents? Okay, well now you're in a 10-point spread. You're looking to make 30 cents against a 10-point spread. That risk-reward ratio is kind of unbalanced. I know, sure, you're going to manage the position before you take too big of a loss if possible. You're not going to allow the position to go above 230 too much before you adjust that 230 call. But is the margin requirement you'd have to put up for that 10-point spread worth it for that 30 cents? Well, that's something we have to evaluate. And then along with that, that comes with applying the commission considerations as well. All right, now before we go to power options to illustrate some of these concepts, the pros and cons and do's and don'ts, I'm just going to launch one quick poll here. What I'd like to know right now is what types of strategies are you currently trading or researching? And what I mean by that is you join this webinar because you want to learn a little bit more about weekly options and get some ideas and concepts of the weekly options. And, excuse me, you're probably doing that because you're interested in maybe trading credit spreads or iron condors using the weekly options, or maybe doing calendar spreads. I've got a lot of you buying options right now. That's kind of interesting. All right, very good. So we're going to leave this poll open for about a minute. We've had it going for about 30 seconds now. And I'm getting good response here. We've got about 50% of our audience already voted in. All right. There we go. Okay. All right, so I've had the poll open for about a minute. I'm going to go ahead and here. Oh, we've got some more votes coming in. So I'm going to leave it open for another 10 seconds. If you haven't voted yet, I encourage you to do so. All right, let's go ahead and close the poll, ladies and gentlemen, and I'll share the results with everyone. So we do have a tie. It was a runaway at first, so we do have a tie now. 50% of you are doing covered calls and naked puts. 43% of you are doing the credit spreads or debit spreads, iron condors perhaps. 32 of you are doing the calendar spreads, the horizontal and diagonals. 50% of you, tie for first, are buying calls and buying puts. And then we have 43% of you doing the protective options, maybe married puts or considering the collar trades as well. Okay, we'll try to address all of those today. Let me go ahead and hide that. And let's go ahead and navigate over now to our Power Options tools. All right, and let's just take a look first. We're going to verify right now the total number of securities that offer weekly options. Now, at any time, if you just want to see a list of weekly options, the best place to go is probably just go to CBOE, and you can go right into their options menu. You can check on weeklies, and there's a list of them there. But on Power Options, we can see the ones that are available very quickly. What I'm going to do is go into Naked Put, just use a single option strategy here. I'm going to go into the search. And this is going to come up with a default screen. And I want to let everyone know that when you're in Power Options, of course, we have a default set up for you. We're going to go back to this for the different strategies. But in most strategies, the income strategies, we have a default search set up for you for applying the weekly options. These aren't recommendations or suggestions, but it's a good stepping stone to use to evaluate these weekly positions, and then you can make adjustments based on your personal goals, your criteria, and your risk thresholds as well. What I want to do right now is I'm going to clear out all the filters for our naked put menu. We're going to select all months, and we're going to ignore this week for the time being. We're going to focus on this next week to expiration, the 10th of April, which is 9 days away, the full week out series. Oh, by the way, of course, I meant to mention this earlier, but I'm sure many of you are aware. If you have any options that are trading this week that are expiring this week, remember the last time to trade them is tomorrow before 4 p.m. Eastern Time. The market's going to be closed on Friday in observance of Good Friday, so you won't be able to make any adjustments on Friday. So if you need to roll your weekly positions, make adjustment, or close them out, you got to do it tomorrow. You won't be able to do it on Friday this week. Okay, so let's put in our time frame. We're going to go, let's just say 3 days to 10 days out in time. And what I'm going to tell the system to do now is only show me one strike out of the money. So when our fields for strikes out of the money, I'm just going to go 1 to 1. Let's submit that real quick. And right now, we see the total number of securities. We're looking at the top 20 there, but the total number of securities that includes stocks, indexes, ETFs, the VXX, which is an ETN, of course, and even the 3 times bull and bear. There's 407 total securities that offer weekly options. Now, every optionable stock, at about the 4,300 available optionable stock, has options that expire in about 16 to 15 days on the 17th of April, which is the standard third Friday. So going out beyond that, about 24, 23 days out in time, is the next weekly series. So let's go ahead and change this now. The 407 that offer the weekly options that would expire this week or would expire next week, let's increase this out to 20 to 24 days in our expiration time frame. All right, and this is just going to show us of the 23 days out. That's the third week, April 24th, and there's 407 results. So now all of the options, all of the securities, that offer weekly options now offer that continuous weekly series. Let's very quickly take a stock here. Let's take a small chain. I'm going to use, no, not going to use that one. Sorry, folks. Good price stock. Let's just use CRE for now. It's a $35 stock. I'm going to link over to the option chain very quickly. Okay, now, in this case, what we do have is we have about technically 6 weeks to expirate, 6 expiration cycles available. April 10th, April 2nd, of course, April 10th, the standard expiration of April 17th, the 24th, May 1st, May 8th, and then May 15th, which is, of course, the standard expiration. So technically, we have 7 cycles right now that we can choose from that are in a row, okay, in a weekly series in a row. We'll lose the April 2nd, of course, tomorrow, but then we'll still have the 10th, the 17th, the 24th, all the way out to the 15th. I don't think the May 22nd series is going to be released until next Thursday, April 9th, but we'll be able to check that as well. Now, I'm going to clean this up a little bit. And what we're looking at here is a standard put chain. And we see here we have some basic, the put price, the time value, volume, open interest, the percent to break even if we sold it as a naked put, the percent naked yield, and the annualized. Well, let's clean this up a little bit. I'm going to go into choose columns. And let's remove some of this other information. We just want to focus on the bid price, the ask price. I'm going to remove volume and open interest this time. I'm going to leave the break even. I'm going to leave the time value and percent time value. Probability I'll leave for now, but we do want the naked yield and the percentage naked yield annualized. Okay, so let's go ahead and refresh that page. All right, now focusing on our out-of-the-money options. The stock's at 35.17. And when we look at the chain, we see that the 2 days out, 1 day out technically, 35 strike can still be sold for 21 to 26 cents, which would give you about a 0.6% yield. But your annualized return is 219 days out. I'm sorry, 219%. Now let's scroll down, take a look at just the out-of-the-money CRE position. 9 days out, so we've more than tripled the time, of course, but looking at 2 days there, we have a 68-cent premium by 74, so we could probably get maybe 71 or 70 cents for this premium. And this is going to yield us a 1.9% return, but look at our annual, it's only 78.8%. for the annualized return. Well, that's what we'd expect. We're not going to be able to get 21 cents every 2 days. Okay, just because we're 2 days to expiration now, that doesn't mean once it closes we're going to be able to sell something on Monday, it expires Wednesday, sell something Wednesday, expires Friday. So naturally we're going to drastically lower this annualized return. But if we compare that to the standard expiration, which is 23 days out in time, the bid does almost double. And this is kind of an interesting factor, isn't it? The 424 weekly option, the 35 strike, has a bid of 193 to 204. So this annualized return of 87.5% is, interestingly enough, higher than the 9-day out series. So if we're able to get 193 to 204, or $2 every 23 days, we're going to have a higher annualized return, 87.5%, than selling the 9-day expiration for 68 to 70 cents as well. So that's kind of important. That's one of the things you want to look at when you're evaluating your positions. It's not only just about the time frame that's involved. Sure, we all want to just sell quickly, 5 days out, 6 days out, get that premium. But based on the stock itself, based on what the stock has done, and based on maybe any events or future-looking volatility, you do see situations like this, where an option that's further out in time, 2 or 3 weeks further out in time, may give you a better annualized return than what's up front. So that's one of the things you always want to compare, and we're going to take a look at an easier comparison on this in just a moment. But first, what are we comparing here? We're comparing an expiration of April 10th to an expiration of April 24th. Okay, so the weekly series out, the standard expiration I didn't have selected to come in here. Let's look at that real quick. So we know that we have a 78% yield for April 10th and an 87.5 annualized yield for April 24th. What does the standard give us? Less than both. Okay, that's only 64.5%. I don't have a poll for this, but I'm just going to open up the forum. Anyone has a comment on this? Can anyone imagine why that April 24th series has a higher annualized return? As we started to go lower in our annualized return from 219, 2 days out, to 78, 9 days out, to 64, 16 days out, and then we go back up to 87.5% annualized yield for the 24-day out cycle, the 3-week out cycle roughly. Does anyone know why that is? Will it happen in every situation? No. Will it happen in some situations? Yes. And I think, let's see here, I've got the answer I believe I'm looking for. Drew says it's maybe volatility due to earnings. And I think that's going to be the case. Let's take a look. I'm going to go to Stock Research Tool. Earnings, right there on CRE, 421 after the market, 3 days before, technically 2 days before the expiration on 424. So there's the situation, and that's the other thing that you have to pay attention to. If you're trading long calls or long puts on a shorter time series, or maybe those long strangles or long straddles, you want the earnings between now and the expiration date of your position. But when you're selling premium, covered calls, naked puts, credit spreads, even the debit spreads, which have a 5-to-1 or 10-to-1 risk-reward ratio, you want to make sure that you don't have earnings between now and expiration. The return looks better, the annualized return looks better, but there's a reason why it's higher. And this might be a position where, remember, we're just selling the at-the-money 35 call, and if we sold, I'm sorry, the 35 put, my apologies, and if we sold that 35 put 3 weeks out, the stock didn't move, and then we see a 10% decline, we did collect $1.94, but we might be down $3 or $2 on our position, so we took a heavy loss from what our expected return was for that premium as well. Okay, so that's some of the other factors. And by the way, what I just reviewed here, analyzing the different positions here, the different annualized return, what suits your needs, and the discussion about avoiding earnings, same thing that applies to any options strategy, whether you're using standard or whether you're using weekly options as well. Same rules for the strategies apply whether you're going with standard expiration, you're using options that are 3 months out, or you're using options in the shorter term as well. Okay, now, all that being said, let's go back to the naked put menu real quick. And I'm going to clean this up a little bit. We have the one strike out of the money here. I don't have the annualized return selected, but I'm going to go ahead and select that right now. We're going to clean this up a little bit just so we can see everything on one page. Let's see here. So I'm going to go into our menu, and I want the annualized naked yield. And I'm going to change the order of the columns a bit here. I want this next to, of course, my percent naked yield. All right, let's go ahead and submit that. Close the window as well. It's going to refresh our page. There we go. So we've got the naked yield annualized. And what I want to do now is I'm going to extend my time frame. I'm going to select it to all months. Let's keep it under 45 days, 0 to 45 days. And I'm going to sort it by naked yield annual. But we're just going to look at CRE. I'm going to take out the field for earnings date, not between now and expiration. Let me go ahead and submit that. Oh, sorry, folks. Let's try that again. 0 to 45. I just want the one strike out of the money. Of course, we can look at other positions too. We'll do that in just a moment. Not between now and expiration, but I just want to see CRE as well. Let's submit that. Okay, so again, here's our differences. And this is what we'd expect to see almost, but it's kind of all over the map, isn't it? What I mean by that is when we take a look, we sorted this by the highest naked yield annualized. And of course, the option that's now technically 1 day to expiration at 21 cents. If we can get 21 cents every day, we're going to be looking at a 219% annualized yield against this $35 security. But then we see that the next highest annual yield is actually 23 days out. It's not the 9-day out series, and it's not the 16-day out series. And we talked about that already. It's because of the earnings. And notice how the May 1st one creeps in here too, with a high yield of 70.6%, a bid of about 203. Now, why is this not in order? And again, we've already discussed this, of course, but even though the further expiration's out, they're not going to be in order what we'd expect to see. We'd expect to see that the highest annual yield would be 1 day, then 9-day, that would be our second one, then this would be our third one, and this would be our fourth, and this would be our fifth, and then sixth, and then seventh, which are in the right place. But we're not seeing that, of course, because the two series that are going to be most affected by this upcoming event are those on the 23rd of April, 24th of April, and May 1st as well. By the time May 8th comes around, some of that's expected to go out, so we don't see as high as an annualized yield 37 days out at premium of 209. Better to get 203 for 30 days out or 193 for 23 days out, but because of the event that's coming up, that's going to be a problem. Now, the way I set up this basic screen, just looking one strike out of the money, we can see this in other series as well. All right, and what I mean by that is let's just change this to, let's say, Apple. Something pretty basic, commonly traded stock. We're just looking at the one strike out of the money for the put series. And this one, again, is a little bit different. Now we have 1 day out, 9-day out, but now the May 1st jumps up slightly above the April 17th and above the April 24th. So that tells us that the earnings are probably coming out sometime after April 24th and before that May 1st series. That's why it's so high up, is because the May 1st one's probably going to be the most affected by the earnings, but we're still going to have a good annualized return with a 9-day out series. All right, now, just wanted to show you that as one of the things to look out for. If you're trying to select which position has the best premium once you've identified your stock, and also gives you the best annualized return that you're looking for, when you see something when you're evaluating these different cycles, 5 to 6 weeks out at a time, if you see something that goes against the grain, you want to research that because it's probably due to some event. Quick story here, I had a customer who emailed in earlier today inquiring about naked put positions. They had a weekly position, I believe, and then the standard position that they had out to April expiration and then one out to May. And they got extraordinarily strong premiums on this it was a $17 stock. And the reason why is because there's a pharmaceutical and has a clinical trial coming out at the end of April. And the problem with that, of course, is that the annualized return for the May series was higher than what they saw for the weekly series and the standard April expiration. And of course, the reason why is because that's going to be affected. But that's much different than an earnings. Okay, I know some of you will trade these positions through earnings, naked puts, credit spreads, for example, where you kind of take that risk of a sudden drop or decline. But on most strong securities, let's say Apple, although we've seen some stronger moves, but in Apple, maybe even Microsoft, for example, things that a 5 to 10% maybe shift because of the earnings event can be expected, but unless it was terrible, you don't expect to see a 30 to 25% drop or gain due to the earnings pop. Whereas those pharmaceuticals with a clinical trial, you could see the stock drop 80% in an hour, or you could see it go up 50% or 100% from its current price in an hour as well. It could double up to 34, or it could drop down to $1 per share. You just don't know. Those are positions I'd look to maybe do long straddles and long strangles, but of course the backdraft of that is that they're extremely expensive because the whole market knows what you know at that point as well, that something's going to come up to cause the stock to swing. But with that being said, I just wanted to show you this so that whenever you see that, you know to further investigate. Now let's go to covered calls. Let's just talk about weekly options with the strategies that you all selected. We had covered calls and even long calls and long puts. I'm going to run a search on that, and we're going to look at some examples and run some quick history on that. I've never been profitable in that. The only time I maybe buy options that have, using the weekly series that are maybe the 3-week out cycle or the 4-week out cycle, is to do a quick calendar spread, not to just buy the option by itself to see what happens. What I'm going to look at here is, remember, in the covered call screen, you have several default searches, and we can start right off with the weekly covered call search. And we have about 91 results that match our default criteria. So what would we look for? What are we looking for when we're talking about doing a covered call with the weekly options? Well, exactly the same thing I'd look for when doing a covered call on a standard expiration or a covered call that's 2 months out in time. Meaning the underlying principles of the strategy do not change just because I'm wanting to use the weekly options. When I do a covered call, of course, I'm buying a stock, and I might be selling an at or out of the money or slightly in the money call depending on your risk tolerance, and if you're looking to get assigned or if you're looking to just generate income on a regular basis against the stock in a rolling position. But what doesn't change is the fact that it's a neutral to bullish strategy. So I'm still, whether using weekly options or standard expiration, I'm going to look for a stock that has maybe a good average stock volume, a stock that's trading maybe in an uptrend. I'm going to look for stock that maybe has to be in my price range. I don't know your account size, but if you're allocating maybe $20,000 to $30,000 of your portfolio to covered calls or cash-secured naked puts, you might not be looking at stocks that are in the $400 or $500 range. You might be keeping it between $5 and maybe $50 per share, okay, depending on your goals. And of course, you're going to want to see something that has good growth, and you're going to want to avoid something that has an earnings date between now and expiration. Now, before I jump into that, let's talk about this. Let's go to a standard at-the-money screen. Our initial value screen, looking at the money options that are about 30 or so days out of time. Here we're going to the next May expiration, 44 days out. Any covered call write-up or guru that you see who's trying to teach you a strategy of covered calls might highly tout that it's possible and that you should expect to make 3 to 6% per month trading covered call positions, okay? And at the same time, you're going to give yourself a good downside protection of maybe 4 or 5%. But you're still going to want to look for stocks that have that same kind of criteria. You want stocks in an uptrend, stocks that have shown good growth, and of course, stocks that have maybe a good PE ratio, and you're going to want to avoid the earnings between now and expiration. Let me put that in as well. Okay? And now, this basic search that we're looking at, we're going out to May, and we're looking for a downside protection of at least 3 or 4%, and a max percent return if assigned of at least 3% as well. And of course, a minimum 40-cent bid price. Well, let's change that. We want to use weekly options, so let's just change our time frame now. I can go to all weeklies, but I'm just going to go to all months, and let's look at both. Let's look at 0 days to 10 days out in time. So I'll see anything that's 2 days out or that 9-day out expiration to April 10th that matches our criteria. Aha! This is what we expected to see. Okay, and we started off with a standard screen that was looking 3 to 4 months out, and what you'd expect as a monthly return, you might try to be looking for in a covered call of maybe 2 to 3% per month. But when we do the weekly options in any strategy, we have to take that into account and factor down what is a reasonable return and a reasonable risk. So we almost want to take this down by a factor of 4, don't we? Because instead of doing a standard series, it might be 30 days out, we're trying to do one that expires every 7 days out in time, so we want to have maybe 4 right cycles or 3 right cycles in that time period. So if I just divide this all by 3, will that work? Sure. I can take my downside protection down to 1%, my max percent if assigned down to 1%, and maybe the percent if unchanged for a covered call at about 0.5%. It means if the stock doesn't move, we still retain about 0.5% of time premium against the position. Those are your return goals for a covered call. But at the same time, can I lower this down to 10 cents? Of course you can, and we'll find some results. But now comes that question that only you can answer trading these positions. Depending on your account size, depending on how many shares of stock you can purchase based on what you're allocating, so we're allocating $20,000 to covered calls, we might want to open 3 to 4 positions. So if each of our positions has an average price of about $30 or so, we know that we can really only trade 100 to 2 contracts at a time to fulfill that allocation. Is this helping us at all? If I buy 200 shares of a $30 stock and I put 6,000 of that 20,000 I was going to allocate to it, and I collect 20 cents of credit, which means 10 cents of credit for the call minimum, which gives me, of course, $20 for 2 contracts. But if you pay $7.95 for the stock, $7.95 for the option, does that help you? No, it doesn't. You're really only making $1 or $2 on the transaction. Sure, you're doing it week by week by week, but you're also paying a commission to roll or to close a position and sell a new call against it as well. Okay? So you've got to make sure, we talked about this earlier, whether you're doing spread trades, covered calls, or cash secured naked puts especially, you've got to make sure that you put in a net credit or a net option bid price that matches and makes sense for your allocation. Okay, so whatever your allocation is, if you on average trade 300 to 400 shares of stock, and your average stock price is $50, you know what your commissions are for that transaction. You've got to make sure that the option premium matches what you're looking for. Don't force yourself into a weekly trade just because a weekly option is available and looks like it has a higher annualized return if it doesn't make sense mathematically. This may seem very basic to all of you, but the truth is, I deal with these phone calls almost on a weekly basis, no pun intended, of investors who say, yeah, I entered this position, but it doesn't look like I'm making any money. I bought the stock, a couple hundred shares, I sold my call, I collected a premium of 30 cents, gave me $60. And I look at it and I say, yeah, well, you paid a $20 commission for the stock and for the option total. And, that wiped out half of it, and then you had to make an adjustment to roll the call, so you paid another $8 or $9. That's where your premium went. So you got to make sure first that that matches your goals, and don't force yourself into a weekly position just because weeklies are available. Let's put this up just to 25 cents now and run the search. I'm going to have a lot of different results here. Okay, so in this case, we have some very high premiums here. And we see that situation again that Johnny mentioned. Johnny, you're still with us, it looks like, but I'm going to get to that in just a moment when we jump into the spread positions. But what I wanted to illustrate here, and Herbalife is a great example. Let's just look at the Herbalife positions that match that basic criteria here. Okay, so let me go back into fundamentals. I'm just going to type in HLF. Now we know that the stock does not have earnings between now and expiration because we put that in. All right, so let's submit that. And all of the expiration dates for Herbalife that matched our criteria of at least 1% downside protection, 1% if assigned for the next 2 to 10 days out in time, so that April 10th expiration. These all offer that. And, of course, we have the differing probabilities as well, as a minimum. But here's the problem that Johnny mentioned. For a covered calls trader, naked put selection, or even the short option at a bull put credit or bear call credit, this is a tough choice. I've got the 44.5 strike. The stock's at 42.47. So this one's slightly out of the money, or these are deep out of the money here in this case. But that's at 52 cents. I get a higher percent if assigned, but I have a smaller probability of the stock reaching that price and getting assigned. The 44 strike, 63 cents. So we're giving up 50 cents of appreciation for a 10-cent higher premium. A little bit better downside protection, much lower percent if assigned, of course. And then, we look at these different positions. We have everything of the 50-cent strike difference all the way down to the 41 strike, which is in the money, offering a good downside protection, but only a 1.1% return if assigned, and, of course, a higher probability of making it. So with these 1, 2, 3, 4, 5, 6, 7, 8 choices here, the question remains. It's on everyone's mind. Not that you'd be trading Herbalife per se, but when you see this kind of setup, the question's going to remain, Which option is the best one? Well, that again comes down to something that only you can answer, meaning that depending on what you're looking to do in a covered call strategy, are you hoping to get assigned and make at least a 1 to maybe 1.5% return if assigned every 9 to 10 days? If so, you want to focus on these two, of course. Right? If you're not married to the stock, you're not considering rolling it, you're not looking for appreciation, you just want to get assigned and earn the return, well, you're probably focusing on these two, on the lower strikes that have a better than 50 or 55% probability and still offering you a pretty good premium. If you're looking to maximize your time value, and as we all know as options investors, our true profit is based on the time value that we make in a position. Well, the best time value, not necessarily the best return, I'm not saying that, but the best time value on any option chain is the option that is right at the money. And we can see that here, the percent if unchanged. The highest one is 2.6%, and that's at the 42.5 strikes. If you're trying to maximize your time frame with a weekly option, you're focusing on at the money. And of course, if we're looking for appreciation, because we think the stock's going to move up, I want something realistic. And something realistic might just be the 44, the 43.5, $1 up or 1.5 up, while still keeping that reasonable 1.8 or 1.5% if unchanged or downside protection as well. So depending on how you trade these positions will determine, are you going in the money and does this match your goals? If you're just looking to maximize time value, and if you're looking for appreciation, or I know some of you are trading covered calls perhaps on stocks that pay a dividend and you're looking to employ the weekly options, just generate a weekly income on a month-by-month basis there, well, you're probably going out of the money as long as that 52 cents or that higher strike call premium still matches your goals for the position. Okay, so with all that being said, let me go back to our weekly covered call screen that we had here. And I just want to remind you that this is a good starting point to use for your weekly series for identifying positions. But change the criteria based on what you want. If you do have that minimum requirement where you need a 45 or 50 cent net credit, just plug that into the option bid price field and then go ahead and submit that. You'll narrow down your list a little bit, and you can even go higher. Just make sure you're avoiding earnings and that you're still applying the same criteria you'd use in a strategy, meaning that you, for a covered call or naked put, you still want that same criteria where you're going to look for growth stocks. You want stocks that have shown good management, have good liquidity. Maybe you only want mid to large cap stocks as well. Don't trade solely based on the highest return and the highest premium. Okay, and if you see something that looks too good to be true, you all know this, but we talked about that weekly series that had a $1.93 or $2 premium for a 2-day out trade on a $17 stock. Well, there's a reason that's there, so make sure you research it as well. I'm going to jump over to the bull puts real quick, and I'm going to address Johnny's question here. Let me just go to the weekly bull put spreads for a moment. The default criteria, we're going to have maybe about 80 results here, I believe. 85 or 90 results last time I looked. Oh, okay. That's why. Let's go 1 to 16 days out. Okay, there we go. There's only one. Oh, I know why. I'm sorry, folks. That's okay. It's the... Should have known this. I'm just going to remove this very quickly, although that I'll still use that in my screen as well. Why is that there? Okay. All right, so that was looking for bullish criteria using the MACD. I'm going to take that out for the time being. Sorry. And we're going to take a look at the bull put credit spreads here, and we want to illustrate some things. Okay, so we have 14 results here that are pretty good. We're looking for a minimum net credit of 15 cents. And again, if that's not what you're looking for based on your allocation, you have to increase that. But we have a better allocation sense now, don't we? Because instead of buying the stock and knowing we might be only trading 200 or 300 shares, depending how much we're allocating to the position, we now know that we can set up a 50-cent spread. So if I'm making 15 cents on a 50-cent spread, that's going to be a very high return, but at the same time, it's almost going to be a 30% return. But at the same time, I know that we can allocate much more contracts. This might mean higher commissions depending on your broker, but at the same time, you might be able to trade 20 contracts times the 15-cent net credit if you still have a reasonable commission. Okay? And here we see mostly dollar strike differences or $2.50 differences. Here's a $1.50 difference as well. Now, to answer Johnny's question, if we just wanted to see spreads, and I don't see any here, but if we just wanted to see spreads that, let's say, offered at least just only a 50-cent net credit, well, the first thing I'm going to have to do is I'm going to have to lower my net credit expectation. 50-cent net credits, even with the weekly, the 50-cent strike differences, even with the weekly series, we know we're only going to have a small net credit of 5 cents or so, 10 cents. But we can set the strike difference any way we want to. And so for right now, I'm going to set my strike difference to be less than 1. Okay? So if I'm using a weekly search just for the next week out, or we're using a weekly search, I should take that 3% out of the money range out as well. But even if we were using a variety, let's go all the way out to 44 months, or 44 days to expiration. Let's go ahead and submit that. So we're looking at all the expirations, but here are all the 50-cent ones. We see the ones that are 16 days out, 9 days out, 23 days out. So this kind of gives you a quick gauge, Johnny, for your previous question, to help you isolate just those positions down that have that 50-cent net credit. Now that being said, let me go to GameStop very quickly. And I'm going to go to the option chain. All right. And we see here that the 1 day out expiration, okay, we've got our 50-cent strike differences, 37.50, 38, 38.50, good. Same thing with 9 days out. And then we go to 16 days out, okay, that's good. And let's go further out. Let's go to the May expiration. I've noticed this on a couple stocks. Okay, and let's even go back to May 1st maybe. Nope, they're 50 cents, good. And the May 8ths are 50 cents as well. Okay. Now, the May 15th one right now doesn't have the 50-cent strike differences. I noticed this last year when I was trading Johnson & Johnson with a radioactive trade. When I looked at the weekly series, 7 days out and then 14 days out and the standard expiration 21 days out, the standard expiration still had 2.5-point strike differences where I had dollar strike differences on the 1 week out, 2 week out, and then the 4 week out, and 5 week out, and so forth. That does make it kind of hard to manage, but what you'll notice is that in this case, even though right now the May positions on GameStop don't have the 50-cent strike differences, when this gets to about 3 weeks or 20 days to expiration, that 36.50, 37.50, 38.50, 39.50, and so forth, those new series will be added as it gets closer to a weekly series. Kind of throws things out of whack a little bit, but it's still good because if I was in a position for this week or for next week's expiration on GameStop, let's say I was in a bull put spread and I had sold the 38 put, and or let's say I sold the 38.50 put and bought the 36.50, so a 2-point strike difference, for example. In that case, okay, so we sold the 38.50. I'm sorry, I bought the 36.50. And now my stock's at 37.78 here, and I want it to roll, and 3 times that May series I needed to roll to good credit to go out to May, but that's not available. Well, in that case, it might be okay because I still might be able to look at the May 8th series, or we could just adjust 1 or 2 weeks out, still probably be okay, and then look to adjust to May 15th later, depending on how this comes out as well. And Dan says, a lot of times the weekly options have very low open interest compared to the monthlies and sometimes hard to get filled. That is true in some cases, okay? Let's take a look back at, to make it simple, let's go back to that naked put screen we had with Herbalife real quick. I'm just going to take a look at some of the numbers there and we can see why. Remember that one of the main reasons why that's going to happen is that your sorry, folks, your standard expirations, for example, the Herbalife positions we looked at earlier, the May series and the April series have probably been available to trade for the last 120 to maybe 150 days. They've been available for maybe 5 or 6 months or so, maybe 4 to 5 months. Okay, so they've had a lot of times for transactions. At the same time, the weekly options may have only come out 20 days ago. 22 days ago, 25 days ago, or so forth. The weekly series that's here may have been out for 35 days. That's still only a third or a fourth of how long the other options have been available. Okay, so just take a look here at this, and I just wanted to go back to our Herbalife example very quickly. Okay, and we removed it last time, but let me just go ahead and add our open interest and volume back in. Yeah. And on most positions, of course, that being said, if we're talking about the standard securities that you're maybe using there to trade positions, for covered calls, for naked puts, for credit spreads, looking at stocks such as this, you'll still see on things like SPY, for example, SPX, you won't have any problem with the weekly volume or open interest. But this does illustrate Dan's point perfectly. Okay? Did I get out to May 17th? Oh, I didn't extend it far enough out. I'm sorry. Let me put this out at 50 days so we get that May 17th series in there. I want that in there too. Okay. All right. So now that we've got that, we see here we've got the May 42 is, of course, the highest yield and annualized yield. 15 open interest, 0 volume today. And that's for the fourth week out, the 8th of May. The 17th of April, our standard expiration, 8,620 contracts, 10 traded today. An open interest of 8,620. The 15th of May, the standard May expiration, the next one, 1,410. You'll see this increase, though, as you get closer to the standard expiration as investors are rolling their standard series to that as well. Now, that being said, let's take a look at SPY, for example. Oh, sorry. And that's just an illustration, of course, that is what you'd expect to see. That is what kind of happens there. You have low volume and low open interest on some of these standard securities, especially these lower price securities under $75, $80 with the weekly series. Apple you won't have any problem with. SPY, SPX, and so forth you won't have any problem with. But even positions like Skyworks Solutions, which is very popular now, it's been on a good run, up and down, a little bit of volatility. Green Mountain Coffee Roasters, Starbucks, you may see some low volatility, some low volume and some low open interest. So again, 15th of May, highest open interest, highest volume today. 16,600 contracts traded today, 116,000 open interest. Standard April expiration, would expect it a little bit more, for the one strike out of the money, but total volume today of 15,000, pretty close, but only 7,000 open interest. And then the next jump is to the 10th of April. So this is interesting. We have more open interest right now in that next series. Probably saw a lot of activity today or in the past 2 days of investors rolling their April 2nd options to the April 10th or maybe the April 17th, depending if they're trying to roll for a credit or make adjustments in that fashion as well. And then, of course, you see the volume today. That's not surprising. Is that our highest volume? Yep, highest volume today on SPY for our at-the-money strikes, I should say, is the 2nd of April, but it doesn't have the highest open interest. That's still here. Okay, so that's what you expect to see. And notice you go 37 days out and 30 days out, you don't see much activity at all, relatively, on these SPY options. Okay, Perry, you put in IT. I don't know if that's a stock you wanted me to look at here on this example, but let's go ahead and take a look. Or if you were trying to comment on something else, I'm not sure. Let's see there. Yeah, IT, that's a tough one. Gartner Incorporated, I'm not familiar with the stock. Oh, they only offer standards. They don't even have the weekly series. These are just standard expirations, the 16 days out for April 17th and 44. But yeah, you're going to have a hard time getting filled on these at-the-money positions. Usually you see the most activity with the at-the-money options and out there as well. All right. Now, for discussion, it's 5:30 p.m. Eastern Time. We've been here for about an hour. I want to open the floor up now to any questions. I know we just did a basic review of the weekly series, some of the things to look out for, and some of the things you might want to consider, setting up the searches a little bit for the 50-cent spreads or the 5-point spreads, and things to be wary of. You don't want to go necessarily, let's go back to that bull put real quick. And I just want to go into that weekly search again, make some changes here. And we want to illustrate that other concept we had discussed briefly. So I'm going to go 1 day out to 12 days out in time. Now let's do this. Sorry, folks. 1 day out to 12 days out in time. Let's go about 2% out of the money with our short put. Still look for minimum net credit of, let's say, 10 cents. But at the same time, I'm just going to look one stock at a time. And let me go ahead and pull up AAPL. And, of course, one last little trick. Look for a probability of 70% or more. Good. Okay, so we have various strike differences. Okay, good. Just want to make sure it's something there. Various strike differences here and various net credits. Well, Apple's at 124.25 because I looked for the 70% probability and I looked for a range out of the money. Our first spread is the 1-point spread. It offers a 17-cent net credit but a higher return, okay, 20.5% because it's 17 cents of credit against a 1-point spread, so our risk is really only 83 cents. We go to a 2-point spread. We could do the 121 to the 119, and this gives us a 30-cent net credit, a much higher, but now we're at a lower return due, of course, so we're looking at a 2-point spread. So we're looking making 30 cents almost double, but now our risk, instead of being 83 cents, our risk goes up to $2.70. So we more than double the risk, the margin requirement, and we didn't quite double the premium. And then, of course, the 120, 119 is a dollar spread again, the 119, 117, and so forth, and the 118, 116. But if I force this to go to a higher spread, which I should be able to do, let me go to a strike difference of equal to 5 points, for example. Okay, why is that not? I have a setting in here that's causing that to pause. Let's go here. Let's go to spread chain and do that. Okay, so I'm going to put in Apple. Sorry about that. Let's look at Apple again. Let's look at our 9-day out series. I'm going to clear everything out. I'm going to go to bull put here, and I'm going to put a 5-point spread, minimum net credit of 10 cents. Okay, and I want the 9-day out expiration series. Okay, so here, the put spreads, there we go. All right, so when we were talking earlier about the 121 and 119 spread, for example, when we see the bull put here, the 121 to 116, we're getting a 54-cent net credit, but we're still seeing a 12% return. So we're getting that better net credit that we saw on the 1 or 2-point spread, but the return is still less. And if I'm only allocating, let's say, $1,500 to a spread position, one spread position at a time, this means I can do 3 contracts, so I'll collect $1.50. On the other side, if we did that 1-point spread and we had that 87-cent risk, and we're still allocating the same $1,500, we could do many more contracts, but now we have to factor in the commissions as well. So the key question comes in, is it better to do a 5-point spread, or is it better to do, let's say, a 1 or 2-point spread? And again, the only way I can answer that is saying it depends on your allocation. Set that first. How much are you willing to allocate in each spread? You want to have a credit spread portfolio, or part of your portfolio in credit spreads. You want to have 3 to 4 spreads open at a time, perhaps. Diversify a little, maybe 5 or 6 positions. But if you know you're, let's say, going to allocate $20,000 or $15,000 of your portfolio, and you're going to be doing 5 positions, you can allocate $3,000 to each spread position for the margin requirement. So with $3,000 in a 5-point spread, that means we could do roughly 6 contracts, 5 or 6 contracts, and we get $2.54 net credit. But if we only had the dollar difference, you could do up to 30 contracts, and if you're making 10 cents there, you're going to get closer to $300. So we do see that with the smaller risks, the dollar spreads and the 2-point spreads, you may be able to trade more contracts, keep the allocation the same, okay? But at the same time, you have the same monetary risk almost. So 5 points times that, you'd have that, 3,000 or 6 contracts. I'm sorry, you'd have that $3,000 risk. Whereas on the 1-point spread, you'd have, the same $3,000 at risk, but you're taking in a slightly better premium if you're able to get 15 cents on those 30 contracts. Okay. Okay, Ashwin asked the question, I don't think it's related to weeklies, but it's just a general question. It says, Apple earnings on the 22nd. When does implied volatility start moving up so that options can be closed? Maybe a week or 2 before earnings, maybe 3 weeks before earnings. It may have already moved as much as it's going to move. It's hard to say. If I'm in a short position, though, and I'm planning on closing it early right now, let's take a look at, let's go to a chain here real quick for Apple. Let's just look at it. And I want to go ahead and look at, I'll take this option here, 9 days out. I'm just going to go to the call research tool very quickly. Okay, and down below here we have the comparison of the implied volatility versus the option bid. I'm going to change that. I'm going to change this chart to the implied volatility versus the stock price. Let's take a look here. So to tell you the truth, from when this weekly option was available on February 26th, 0.26, and we're below that, we haven't really seen the increase in implied volatility. We also haven't seen the stock move much, even though it's been moving down. So to tell you the truth, I'd say it hasn't happened yet, but we could go ahead and do that going forward. Okay, you're probably going to see that. I don't know. I mean, you'd have to maybe run some historical tests, Ashwin, and look at some historical options chains, which we offer on the historical services here at PowerOptions. But you'd have to go back and maybe go back to, in the historical chain, go back to the last earnings 3 or 4 weeks before the last Apple earnings and scroll through for the day and see when those implied volatilities started to change. But you have to make sure that the implied volatility change that you saw in the options weren't related to a sudden drop in the stock price as well. Jacques asks, how can I screen for diagonals? Okay, well, I already have that selected. The first thing you'd want to do is go into the Other Strategies tab if you hadn't already. You want to go into Calendar Call. Let's go into Calendar Call and click Search. And, here's the basic setup. But if I'm screening for calendars for a diagonal spread, I'm going to start off first, Jacques, by cleaning out the filters. And, okay, I just want to check there. So I'll start off with my first series. I'm going to, again, look all months for my short option from, let's say, 1 to maybe 15 days out in time. Now for my long option, I'm probably going to want to start off maybe 25 or 30 days out in time, 1 month out, 4 weeks out in time. So let's put it to 25 to, let's go to at least 45 days out or maybe 50 days out if you're trying to do it closer in spread. In general, when I'm doing these diagonals, I'm typically going at least 3 or 4 months out in time, even if I'm using weekly options. So I have my settings here set at about 90 to roughly 140 or 150 days out in time for that position. But let's keep it shorter term. Let's keep that, what did I say, 25 to, let's go to 50. Okay, now, what are you going to look for? Well, you know you're going to pay a debit, but what is your debit requirement? You're looking to sell weeklies against it, so you should still expect a return, a leverage return, maybe around 3% in the best case scenario if the stock's trading right at your short call strike price. And downside protection, this is the option premium you're collecting divided by the option that you're buying, so you make that maybe at least 1%. In general, field that we have here is that the debit to strike difference ratio. With a diagonal spread, I always want that to be less than 1. So that the option that I'm buying, the difference in the strikes between the option I'm buying and the option I'm selling has to be less than the net debit. So if I do get assigned early and I'm forced to exercise my long call to deliver the short obligation, I make sure I guarantee a profit. A lot of people will enter in the diagonal spreads by buying an option and selling the near-term option and paying a debit that's greater than the difference in strike prices. And in that situation, if they get assigned early, they're in a maxed loss, or they're guaranteed a loss as well. Let's see. So for my my near call, the option that we're selling, I might want it to be at least, let's say I'll say maybe 0 to 3% out of the money. And then for the far call that I'm buying, I'd want that to be maybe at least reverse of that for the, let me go at least 1 to 3 strikes in the money. Okay, slightly in the money there. Now I'm just going to leave that alone for now for the time being as a basic screen. Let's see if we get anything. All right, so we have 500 total results. It's way too much. Knowing now that's a neutral to bullish position, we're probably going to enter in some of those same fundamentals we saw for the covered call. We might look for stocks that have good growth. I might want to avoid earnings between now and the expiration date. We might want to look for a good PE ratio, 0 to 50, for example. And, of course, I may also want to look for, go to the technicals here, look for stocks in an uptrend. Maybe the stock's trading above the 20-day or the 50-day moving average. So let's narrow that down. Might not get any at this point. Oh, 364 didn't narrow it down as much as I wanted to. But these are closer in spreads that I don't particularly like to use in my personal account. We're using that shorter term, and then you're buying the option that's 30, 37 days out in time. Again, I like to give myself more time, and following the standard rules we talked about at the beginning of the presentation, anytime I'm buying options, whether it's part of an insurance for a stock in a married put or maybe even a collar, I'm buying an option as part of a calendar spread position, or buying an option speculating on a market movement as in buying a call or buying a put, or buying a strangle, doing an earnings play, I'm usually going at least 3 to 4 months out in time minimum for that position to put it in the proper context of, when I'm buying options, I want to buy further out in time, because the option that's 4 or 5 months out, 4 or 5 times out, won't be 4 or 5 times the cost as well. Okay, so that's what we're kind of looking for in those scenarios. But that's how you can set up the search shack. Put in your short option time frame that you're looking for the option that you're selling, and either calendar call or calendar put in the time frame you want. Start off with the basics. What are you looking for a max return? And just as we saw with the covered call, if you're expecting a leverage return with a calendar spread, if you sell a standard 3-week out option or standard expiration and buy 4 months out, and you expect a 5 to 12% yield, you may have to scale that back a little bit when incorporating the weekly options. Look for maybe only a 2% or 3% maximum return and maybe a good downside protection. Set your range out of the money or in the money for the 2 options, the option you're buying and the option that you're selling. Or if you want to do horizontal spreads, you can set that up as well. The at the money, let's say, for example, on our first one here, the ACN at 93.56, you want to see the ones where you're selling the 94 April and buying the May 94 or the June 94. You can set up the screen to do that with the range at the money and out of the money as well, based on what kind of calendar spread you're looking to accomplish there. I will say this, that the spreads that we build here on, let me just look at, I'll just use this one here. Let's look at the profit and loss chart quickly here. Our diagonal spreads, we feel as a diagonal spread is we're going to buy an option, we're going to sell the near-term option in a calendar call. We're going to buy an option that's at a lower strike price and further out in time. I know some investors do the opposite. Okay, they'll do a calendar call spread where they're selling the short-term at-the-money option, and they're going to buy a couple months out of the money looking for the lower debit. Well, that's just a different way to approach a bearish position. That actually turns into a bearish position because you need the stock to be trading at or below the short call strike price in that scenario really for the best view and the best return. The advantage of that is it costs a lower debit, but at the same time, before you do that sort of reverse calendar you're talking about with the calls, I'd compare it to the parity trade of a calendar put spread, because you're probably going to get a better return by selling the at-the-money put and then buying an in-the-money put. Even though you're going to pay a higher debit, the return's probably going to be higher as opposed to that other form of diagonal spread, what I call a reverse diagonal, where you're buying a call or buying the option that's out of the money at a higher strike price in the case of calls, but you're buying the out of the money and selling at the money. We prefer to buy in the money and sell at the money here, and that's the sort of search we set up. We could do the horizontal as well, where we're selling the same strike series. Just gives you a tighter profit and loss chart and a lower range to break evens than the standard diagonal spread here as well. Okay, so once again, if anyone has any last-minute questions, go ahead and send those in. I'm going to navigate back over to our screen there. And of course, one thing we didn't touch upon, and I've got to go back to the other screen to show something else. The great debate I always have with customers regarding weekly options, is it best to roll the positions on expiration to the next week? In other words, yesterday, today, or tomorrow, am I going to go ahead and roll my position, close my weeklies that expire on Thursday, and roll them out to the next week for April 10th? Or is it best to just let them expire and close them, and then wait till Monday to sell the next series for April 10th? Well, unfortunately, both are valid approaches. The answer to this question that always comes up, is it best to roll the positions on expiration or before expiration to the next week, or let them expire or close them at the last minute and then enter the new trades on Monday? The unfortunate answer to this question is really that it depends. Both are valid ways to adjust the position. What do I mean by it depends? Well, it depends on the unknown. It depends on what the stock does on, from Friday to Monday. What does it open at on Monday? Is there any event that happened over the weekend? My personal preference is to allow the positions to expire or close them at the last minute to try to get as much time value decay as I can, assuming that it's not too far in or too far out of the money or has gone against my trigger points already. All right, so we're going into expiration tomorrow. I have a couple of weekly positions that are on the fence. I'm going to hold them as long as I can unless it starts to get away from me before I adjust the position. But more than likely, I'm going to look to just buy back those options and then look for the new positions that expire on April 10th, on Monday the 5th. Okay, that's probably what I'm going to look to do. But this is a great debate. The pro of rolling is that if I rolled now and rolled out to April 10th, I close my positions tomorrow, or roll them, I should say, to April 10th expiration, 8 days out in time, I'm going to technically really get, in this situation, we're going to get 3 days of time decay when the market's not doing anything. Okay, so you're going to have Friday's going to pass with no trading, Saturday, Sunday, we start Monday. What's a 9-day trade? We just passed 3 days, so I've gotten a third essentially of the time out of the way when I was in the position. Okay, so that's one of the advantages. If you asked Ernie, who's trading weekly options on some of his spread positions as well, he'd tell you that it's a great idea when a holiday's coming up to have those positions. But it also runs the risk is that we don't know what's going to happen over the weekend or the sudden gaps in Monday market. And what I mean by that is you saw the positions we ran our search for what would match our criteria for 9 days out. A lot of the positions, even on $30 and $40 stocks, were 50 cents to $1 to maybe $1.50 out of the money. We might see a change, whether we did a bullish position or a bearish position, of 80 cents to $1 or more when the market opens on Monday. We just don't know. So sometimes it's better to see what the market does on Monday and then enter your new weekly positions, even though you only have technically 4 or 5 days of time. Maybe rather than rolling it just on Friday to where you have 7 days of time and you lose 2 of those when the market's not trading, but we don't know the unexpected event on Monday. This is more of a personal risk tolerance question. Are you comfortable leaving an option that you may have only received 30 or 40 cents for a selling premium that's 1 to 2% out of the money over a weekend period, not knowing what can happen, what events can happen? Greece could falter their loans again. We could see some disheartening news about IS making advancements, anything along those lines that could cause market hesitation. Or good news, if you're in a bearish position, hey, factory reports look up, speculation for Q2 looks higher than for Q1, things of that nature, and just pops up on you without expecting it. That can cause you to manage that position very quickly. Did you get that extra 2 days of time decay? Yeah. Did it help you if you have to pay $1 to roll your spread when you only collected 20 cents in the beginning? Not really. The time decay didn't work in your favor in that case because of the gap. But that really is the great debate. And a lot of investors go back and forth on this, and unfortunately, I got to say, the real answer is it depends. It really does depend on the situation. Something that tends not to have much movement or gaps, say SPY, QQQ, maybe even SPX or the indexes, that might be a better approach for rolling and then being okay leaving it over the weekend. But again, that depends on how far out of the money or in the money you're going depending on your position, what protection you have in place. If you're right at the money or just slightly out of the money on one of those $30 stocks and you only collected 20 cents for the bull put spread or maybe 30 cents for the naked put by itself, there's that hesitation there. We don't know what could happen on Monday. It could move against us quickly as well. Now, in my opinion, the keys to remember when researching and analyzing your weekly positions, always remember that the weekly options are no different than anything you've learned from the standard expiration. A weekly bull put credit spread has the same rights and obligations and requirements as the standard expiration, just a shorter time frame. Now set your goals and allocation to the strategy first. I really believe that's important. Don't go looking for a premium on a weekly position for a bull put, bear call, iron condor even, and then say, oh, okay, well, this is going to offer me a 20-cent credit on a dollar strike difference, so it's 80 cents. Let me go ahead and apply $8,000 so I can do dozens of contracts in that case. That's not a good way to approach it. No spread position should probably be more exposed than 3%, 2% of your total portfolio value or the total money you're allocating to spread positions. Okay, you don't want that to be too high. And this will also help you for trade allocation. If you set how much money you're going to allocate to a spread or to a cash secured naked put or for a covered call position, that'll help dictate whether you're going to be doing 5 contracts, 10 contracts, or 300 or 400 shares and 4 contracts on the covered call position. So it's easier at that point to factor in what are your commissions going to be for that 4 or 5 or 10 contract spread based on what you're collecting as far as raw premium. And remember, when we talked about that covered call or the spread position, if I'm using standard options on a covered call and I want to look for the at-the-money positions, I can expect to see a 3, maybe 3.5% return if assigned while still having a 4 or 5% downside protection. With doing weekly options on covered calls, I may only expect a 0.5% return if unchanged, maybe a 1% return if assigned, and a 1% downside protection, meaning I'm only 50 cents or maybe $1 in the money or out of the money, which means that I have to watch it more closely if I'm trying not to be assigned or if the stock starts to go against me. If the stock has a 2-point drop, and the first day after I enter the trade, well, I can buy my call back more cheaply, but I'm going to have to manage it more effectively. Okay, and if it has a 4-point drop, I didn't get as much premium as I would have by selling a standard option, so now I'm looking at a harder loss. Can I still sell more over time to increase that annualized yield? Yes, but you have to still be careful on the downside. Same thing is true with the bull put credit spreads. You're going to be able to find a lot of credit spreads that have your 70 or 75% probability requirement, but not a lot of them are going to have your minimum requirement for probably a 20 to 30 to 40 cent net credit. Okay, that's the trade-off. So you find a position that has a good probability of, let's say, 75% or more of expiring worthless, and you have 25 cents of net credit. Well, that probably means you might be looking at a $50 stock, and you're probably selling the 59 put and buying the 57, or selling the 58 and buying the 56. So if the stock drops 2 points, you've lost on that trade already. All right, you're in between the strike prices. You're going to have to manage it. So that's the other downfall, not really downfall, but one of the keys to remember with weekly options is you have to watch them more closely and you have to manage them more closely as well. And that's where our portfolio tools come into play, and we're not going to have a chance to cover that today. But I want to jump back in real quick here to our Power Options screen. And I just want to show everyone here. I'm going to go into the archived webinars here. I'm going to go to Option Strategies. And for those of you, of course, that were doing the naked puts, I want you to focus on this position here, managing your naked put positions. Some of the context there also applies to covered call. And all of you doing the credit spreads and debit spreads, Condor's 50% of you, you want to take a look here at managing your spread positions. And we go through a discussion of using the weekly options or standard options, what target prices to use, what you might want to use as a mental stop, and the different ways you may look to manage those positions as well. And by the way, while I am on this page right now, I just want to let everyone know today's presentation here is being recorded. We're going to post it probably tomorrow morning. It's going to be posted here in our options concept. So the weekly series here will be posted with our other presentations on implied volatility, the Greeks, insuring a stock or portfolio, concepts on waiting to roll, and so forth. So that's where you'll be able to see this presentation tomorrow morning. We won't have time to post it this afternoon as well. All right. Well, ladies and gentlemen, I don't see any other questions coming in for our presentation. Remember, if you do think of a question later on, just go ahead and send me an email to support@powerop.com. Remember, you can also reach us during market hours at 302-992-7971. There's also contact links on the bottom of every Power Options page. Well, thank you once again for joining me this afternoon for our basic introduction to the weekly positions. In the near future, in the next month or two, we'll have special presentations on weekly options that are strategy-centric. So we'll have presentations on weekly options for the credit spreads, weekly options for covered calls, that'll get more into detail in each of those strategies, probably even the calendar spreads, of course, as well, and maybe even some of the call buying positions also. So look forward for those. We'll let you know when we're having those presentations. We'll let you know when today's webinar is posted as well. Take care, everyone. Have a fantastic evening, and we'll see you soon. Good night.